The Share Pickers Podcast.
And joining me on the podcast right now is James van den Bergh, CEO of TruFin. TRU is ticker. James, thanks for joining me.
Pleasure, Justin.
Now, you've released a trading update, highlights for the year, and I've got to say, every metric pretty much I'm looking at is improving. And when I'm looking at companies, that's the kind of thing I look at. Is it improving? And it seems to be improving. So we'll go through that in a bit, the detail of the update. Before we do, James, for people maybe not familiar with TruFin and not quite sure what it is, just explain what you're about, please, if you could.
Yeah, so TruFin, so collectively, we've got three businesses, and collectively, we provide software and niche lending solutions to thousands, tens of thousands of businesses across the UK via those companies. We've got Oxygen, which is an early payments business, predominantly selling to the local government space. Satago, which is an invoice financing platform that is now selling lending as a service product to banks. And we've also got a very significant interest in a predominantly console gaming business called PlayStack. So those are the three businesses. We had a company called Virtus last year, which we've now sold.
Yeah. Okay. Well, if you could, before we get into the individual parts there, just give us a top line of the financial highlights, if you would.
Yeah, certainly. So last year, so over the 12 months ended 31st of December, we grew in excess of 30%. So our top line revenue grew to 20.2 million. Our EBITDA loss improved significantly. So we saw an improvement of 47%. To 3 million, and our adjusted loss before tax is going to be in line with market expectations. That's the Liberum's expectations at no more than 6.3 million. So again, that improved versus last year. So across the board, I think, as you quite rightly say, across the board things are improving. When it comes to the individual entities, Oxygen grew revenues by 18%. Satago grew revenues by 72%. And PlayStack also grew revenues significantly. So, yeah, across the board, we're growing fast. The underlying metrics are improving, and the key KPIs that we follow very closely as a company are looking very, very resilient. So we're very pleased with progress.
Yeah, and I suppose, you mustn't miss off there, because investors always, I said, if you're currently a loss-making business, one of the most important things is cash, and how much cash do you have, and how long will the cash last?
Cash at the year end is no less than 9 million, of which unrestricted cash is no less than 5.5, and we go and say the group is fully funded to profitability.
That there is a key phrase, fully funded to profitability. I like that a lot. And in fact, I was looking at the broker forecast earlier on, and they've got a target currently which is about 150% up on the current share price. And I was just looking at the growth.
Being very conservative, Justin.
Yeah, being very conservative. Yeah, I was looking at the current growth forecast and where you come from, really, actually, and where you're going. So from 21 to 22, 23% growth top line. 22 to 23, 25% growth. 23 to 24. 58% growth forecasted, and even gone beyond that. The figure's getting bigger here, so the percentage growth is harder. But even then, from 24 to 25, around about 38% top line growth. That's really firing up and kicking into gear there, isn't it?
It certainly is, and you've got to remember that this year to 23, we were expecting higher growth. So one of the things, even though we grew in excess of 30%, which is great, we were expecting to grow faster. The Q4 revenues at PlayStack were lower than expected, even though it grew significantly last year, because a number of platform deals that we were looking to sign, we didn't manage to close in Q4 last year. So that meant that the revenue, the overall revenue, group revenue for 23 was lower than expected, but we didn't change our 2024 forecasts because those are unique individual transactions that don't go on to impact 2024. Now, obviously, those deals are still in the pipeline. We're still discussing in negotiations with. So those deals that didn't fall in 2023 may well go on to fall in 2020, or we may conclude in 2024, which would make the growth even faster. But we didn't change our 24 and 25 forecasts because those deals don't impact the forecast for 24 and 25. So that's why it looks like an artificial step up in growth, which is great. And we may, we're obviously looking to conclude those platform deals as well. So we'll see. So that's the rationale. Each of the companies is doing fantastically incredible things across the board. And So yeah, the numbers you're talking about are eminently achievable.
Yeah. Well, do you know what? I did say there's everything's improving. The only negative I found was the delays in PlayStack, and that was the only sort of negative thing there. And I suppose. And maybe, I mean, the share price has dipped recently, and there's been a lot of gaming companies have taken a massive hit, and even the best literally are down like over 50%. And so, do you think that's part of the reason why? Because you got PlayStack, do you think that the sentiment is knocking the share price?
Well,
maybe?
I think. Well, obviously rates higher, but there's a general risk off, and TruFin is a sort of a unique asset. Obviously I love it, but I can see why it is a relatively complex asset company relative to a simple company that does one thing. We've got three businesses that we think all three do their thing very well, and so naturally shareholders are going to take less time to look at TruFin than they might some other asset. And obviously our job as the management team and the board is to make sure that we realise full value for all shareholders from all the assets. And we feel that, and if we do that, then the target price that Liberum got is very conservative. I think you're absolutely right, though, on PlayStack and gaming as a whole. Not singling out PlayStack for the industry as a whole. Post-COVID, when there was a sort of artificial bump as a result of COVID, the industry did overinvest, not just in people, but investments, etc. And that has come back to bite them as the market sort of reset. The overall trend of gaming is still on the up. Yeah. Gaming is still bigger than Hollywood and the NBA put together. I mean, it's an amazing industry to be in, but there's definitely been a bit of a reset. And some of the larger platforms, I won't mention it, the names have definitely curbed their spending, which has impacted the overall revenue of some of the console gaming businesses. But we're very confident on PlayStack going forward, and I think maybe sentiment is a bit too negative on some of these console and gaming companies.
Yeah. Well, listen, I've got two sons. Okay, one's 14. In fact, one's his birthday today. He's had a new PC to play, do game basically. That's all they do. Great. Just dragging them off the games is the problem. Yeah. There's no lack of demand there. They love it. So I'm testing that.
Tell them there's a great game called Mortal Shell and The Last Faith and the AK Slottle, and I'll send you a few links to get them to play.
But I understand why people sort of went overboard and all they did in COVID was that. But let's be honest, the trend isn't going down. More people are gaming.
And it's not 14. It's not just 14-year-old boys who play. It's everyone who plays. Yeah. It's adults as well. So it's a fantastic industry to be in.
Yeah. So let's touch on oxygen.
And I think so. Just going in, one of the reasons in the trading updates, if your listeners do go through our trading update, we gave a lot more granularity on PlayStack. At the end of the trading update, I'm sure you've read it all, Justin. Yeah. But we talk about how the business. So in 2021, one of our games made up 85% of PlayStack's revenue. And last year, 23, 85% of the revenues were generated from 8 games. So it's a much more diversified business. Mm-hmm. We then go on and we've got 6 further major launches this year. And we go on to talk about the returns on capital. So again, a lot of investors and maybe your listeners think of gaming as you've got to throw a lot of mud at the wall and hope something sticks. But actually, if you look at the data of the returns that we get on the advances that we make to developers, the returns we talk about, we get over. Well, if you no cherry picking, all the console games, PC games PlayStack's ever launched since inception, the average return on invested capital is over 380%. With an IRR of 300%. And if you exclude our highest grossing game, the average return on invested capital is still 91%, with an average rated IRR of over 200%. So, and the highest ROI from a single game is over 1,000%. We've lost money in one game and we lost £16,000. So the point is, if I heard those returns for any other business in any other sector, people would be falling over themselves to invest in a business that can create a repeatable process to generate those types of returns. And that's what PlayStack's doing. And so we're going into a lot more detail in this RNS about PlayStack, about the returns it's capable of generating, and we expect to continue to generate in the future.
Yeah, that's almost reminiscent of the way that the PlayStack is managed there is almost like portfolio management. Is it risk
Yeah,
management?
it
It's
is.
knowing how to do it.
My background is, as you know, portfolio management. So that's exactly. We ignored all the noise. Just go into the detail. Go look at the data. And if this were a portfolio manager or a PE fund or whatever it is, you look at that and go, these returns are sensational. And most importantly, it's a repeatable process. This is not, an art form. Yes, there's a lot of skill within the PlayStack team, but we've got tech that allows us to identify games early. We've got a process to select the games, to publish games, to distribute the games, the relationships we have with some of the largest technology companies in the world, which we're not allowed to name, but I'm sure you've seen. So we've got a process that from start to finish means that we see that there's a very repeatable process. Whether the returns are as high as those in the future is to be seen, but it's certainly a very, very repeatable, scalable process, and that's what PlayStack's going to continue to do.
Yeah, absolutely. Marvellous. Okay, well, let's move to Oxygen, number one in the market. Just touch on what it does, James, if you could.
Yeah, so Oxygen offers early payment software to predominantly, it does have other clients outside local government, predominantly local government clients. So that means the software puts in software and processes into large councils in the UK, and that software, along with the internal team from the councils being trained up, it allows them to pay their invoices early. So rather than paying on conventional terms, which may be 30 or 60 days, with the software and the systems that Oxygen integrates into councils, it means that councils are paying their suppliers earlier than that predetermined date. And the discount, say a council pays on day 10 rather than day 30, that extra day of acceleration of payment, the council receives a rebate for that accelerated payment. And in a world of higher interest rates and tighter liquidity, etc., it's even more attractive to suppliers to have payments early. So we are effectively facilitating acceleration into the local economies up and down the UK, and we get a cut of the rebate that the council receives from the suppliers. So that's the majority of our business is that. We also have a data side of the business called Insight Solutions, which aggregates data on tenders, etc., and sells it back to suppliers who are looking to tender into councils and also the councils themselves.
Yeah, well, is it £1 billion worth of transactions going through this?
Oh yes, upwards of that. Yeah, upwards. And I forgot to mention these contracts are 5 years in nature, so they're very long dated with fantastic clients, and the contracts tend to be renewed very frequently. So they are very long dated contracts. Hundreds of billions are going through. We have a part of the program is called Free Pay, which we initiated a few years ago, which is for small and micro suppliers for our clients. They can pay their small and micro suppliers early. So say moves from day 30 to day 10 or instantly, and they pay those suppliers with no discount. So if they owe the window cleaner £100, they pay the window cleaner £100 on day 0 rather than day 30. So which adds enormous value into the local economy, and there's no charge for the local supplier. So last year, we facilitated free early payment of over 600 million to small and local suppliers, which is an amazing achievement. So, and that was around 15,000 small suppliers. The year before it was around 10,000. So that's growing really fast, and it's an amazing thing for local councils and government to be able to offer to their suppliers, and it's really helping us when it comes to pitching the product to councils, etc. So it's wonderful to see that initiative work so well.
Yeah, exactly, and like I say, it's growing there. And you said looking ahead, pipeline exceeding 100 potential early pay clients, 40 of which are active, and there's quite a high proportion of, is it half? Is it two products or more, is that right?
Yeah, so on the pipeline side, we've got over 50 clients today. We are the number one. In fact, the number two has one client and is no longer offering that service to that client. So we are there's always someone who pops up and tries to compete with Oxygen. And whenever I see it, I think, good luck, because no one's got the time frame or the capital to replicate, I don't believe, what Oxygen has built. Obviously we're not complacent, but we feel we're in a really, really dominant position. And yes, one of the strategic initiatives 3 years ago was to look to sell other products to our clients. So we have a fantastic relationship with our clients, which we really value. They value all the work Oxygen puts in, and the value, and it's the value of the service. And so we and our clients were saying, what else have you got that you can provide us? So we look. At some point, Oxygen won't be part of TruFin. At that point, we want to prove to the future owner that Oxygen has got these fantastic relationships. And it's all very well saying they've got great relationships, but actually the only way you can prove that is, can you distribute other product into those clients? So we started cross-selling other products, our own products and other third-party products into our clients over the last few years. So this year, the year just gone, 23. 50% of our counter accounts, of our early payment clients, purchased 2 or more products from Oxygen. The year before it was 17%. The year before that was around 9%. So we're proving again, which makes, we believe, Oxygen even more valuable to, let's say, a private equity buyer that wants to do a buy and build or a land and expand, whatever the ambitions they may have. We're proving the value of Oxygen in that, if that's their plans in the future. So that's the initiative, and also obviously we want to grow the products we offer to our clients because we think they add enormous value.
Yeah. Do you know what? It's nice the dynamic you have between these different parts of the business, because Oxygen there, like you say, a lot of visibility, reliable clients there, and steady adding, and literally the clients stay with you for a long time.
Yeah.
And next one is Satago. Like I said, it's whenever I look at companies, I try to find companies that are best in class. And what does that mean? It's hard to evaluate what's best in class, but when you see some FTSE 100 companies using the product of a small company, thinking, why aren't they develop their own product? Because obviously it's quite complex to do, but they obviously realise the product out there is better than what they have, and so anything out there. So, and Satago seems to be like that. And Lloyd's is working with a huge business like Lloyd's can take time because different layers of management, all that is very complex. But I said that the amount of customers they have are huge. But it's seemingly starting to take off now, isn't it?
Yeah, it is. And just going back one thing, and before we go into one thing to remember on Oxygen is, because of the nature of the contracts, that they're slow burn. We've done all the heavy lifting on Oxygen. It's now profitable. It paid TruFin back a dividend last year, and 90% of the future growth that we've got, or the analysts have got forecast, is from clients already contracted with. So if we don't win another client, 90% of the future business is in the bag. So and obviously every year you can see from the pipeline, every year we win more and more clients. So just want to make sure that's your listeners fully understand that the durable nature of Oxygen. Yes, on Satago, you're absolutely right. To get to win not just Lloyd's but also Sage and to have them as clients is an amazing achievement, and proves the value of what Satago is bringing to these entities. So we're thrilled by what's going on. We're very lucky to have Lloyd's not just as a client but as a shareholder in Satago, and our relationship with Sage is fantastic. So we are, there's many years of growth ahead at Satago. Many more clients that we're potential clients that we're speaking to, other banks you can imagine in the UK and elsewhere. So we've got an extremely healthy pipeline, and the team there are looking to continue to deliver on the various milestones that we and our clients have set ourselves.
Yeah, well, just looking at the growth here, and if you can measure it in some way, I'd say revenue's gone up 70%. Of course, at the moment it's from a small base, but from 2.2 to 3.8. But nevertheless, when you see that subscriptions has doubled. The subscriptions that people are doing is from 430 to 967. Yeah, that's got a long tail there, isn't it?
Yeah. No, it's we like you say, it's from a small base, and we don't want to be complacent. But the opportunity set in Satago is very very large, and we're growing. It's growing fast. we're focused on delivering for our clients a phenomenal product, for their clients, and for their clients a phenomenal service. And that if we do that and we continue to do that, then Satago will flourish. So yeah, it's great to see these numbers come through. We think they're set to continue. Well, they will continue, but it's great. It's great to see the company really beginning to flourish.
Mm-hmm. Cool. Okay, so what's your favourite business here, James? Which is your favourite one?
Well, it's like, you tell me which one's your favourite child, Justin?
Exactly, I know. The one that's quietest doesn't bother me the most. But, yeah.
But you like a bit of flair sometimes as well, don't you?
Yeah.
They've all I've been involved with all of them since TruFin has been involved and pre-TruFin. So it's great to see them all hitting their stride.
Yeah, absolutely. No, it's going well, and like I said, hopefully, we'll catch up soon because, like I said, everything here is seemingly improving. The only negative that could read into it is slight delays in PlayStack, but like I said, it's just delays. So it's nice to see the story evolve, James, and hopefully we'll catch up in the not too distant future. Thanks very much.
Yeah, pleasure. Thanks, Justin.
The Share Pickers Podcast with Justin Waite. Content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.